Hey there, Open Forcers, and welcome back to this episode of the Gig Academy, where we talk about all things gig economy and independent contractor related. Today on our show, we've got a Spencer Tenney. Spencer, would you mind introducing yourself to us all?
Happy to. Good afternoon, Open Forcers. Spencer Tenney, President and CEO of the Tenney Group. We're an industry specialized merger and acquisition advisory firm and been dedicated to transportation logistics since 1973. Primarily, we serve the transaction advisory needs of owners who are selling and have companies with annual revenues somewhere between 20 and 300 million in annual revenue.
Excellent. That's awesome. Well, thank you for joining us today, Spencer, and let's get the discussion going. Obviously, 2021's been pretty interesting, just like 2020 kind of caught everyone by surprise. So much is going on right now with the supply chain and the logistics industry specifically. There's market volatility, driver shortages, labor shortages, just to name a few. Is now still a good time to acquire a business or to merge with another business?
Well, I think that's, I think that depends. I think it depends on if you're interested in building value, because quite frankly, right now, with all of the disruption, even with pricing being quite favorable to carriers right now, that there's still tremendous inefficiencies because of the disruption in the market, and there's significant cost increases across the board. So really, what's changing now is why is it a good time? It's because it's essentially a necessity if you want to grow and you want to continue to build value, because it's very difficult to offset these rising expenses. It's also very difficult to grow without drivers or trucks. So I think that's the issue. It's essential. It's an essential time to grow through acquisition if you're serious about building and protecting business value.
Do you think there would be any other ways that a company could continue to grow without merging or being acquired? And if so, what would those be?
Well, I mean, I think there's, traditionally, the vast majority of folks have grown and built phenomenal companies through organic growth, expanding existing relationships. But the constraints right now on those same companies is that, for a while, even the last 24 months, we'd have people say, I could grow my business by 40% overnight if I had the drivers.
Right.
Well, that's even gotten even more challenging, because now it's like, I'm a year out from truck orders. I can't get that either.
Yeah.
So I think it's really required business owners to reinvent and expand their playbooks about how they're going to do business and specifically grow and meet and compete in the market.
Absolutely. Yeah. And we see that all the time. And when we speak to our clients and everything, driver retention and acquisitions are very difficult. And it is definitely a non-conducive environment to finding bodies right now to get in the seats, whether it be, couriers or, truck drivers. I was just reading, and I'm sure you saw it today. I think the story just came out where, they're trying to get 18-year-olds to drive 18-wheeler trucks because, the old guys are retiring and not a lot of people, that are of the 21 age limit that's currently set really are interested in doing that kind of work. So it is a challenge that is being faced in all those.
Right.
Yeah. So kind of keeping in line with this question, what trends are you seeing now in terms of mergers and acquisitions and, all of those issues we're just discussing, and what do you expect to change in 2022 and beyond?
I think some of the trends that we're seeing from the transaction advisory vantage point is that, we're seeing deals right now. We have a very large company that we came to. We brought to a disrupted vertical within transportation logistics. We thought we had, a perfect profile of a candidate that's just, it's a no-brainer. Why wouldn't they do this deal? It's right in their bread and butter. But their situation was, we can't afford to do that because there's so much uncertainty around this particular vertical due to the disruption within the supply chain. We can't continue to double down on that particular area of the business. And so within that same conversation, we got to talking about, we weren't trying to pitch the deal, but they were asking like, hey, I heard you had this type of deal. Can I hear about that? And this is something that we would have never anticipated that they would even have considered. It's not, I mean, on paper, it makes no strategic sense, but what's happening in terms of a trend is that this is the reality of the market as far as reinvention. If something that you can't control is kind of shutting down your ability to grow and prosper, then you have to pivot. And so what we're seeing people that are highly specialized in one area, rather than trying to grow in that same area, they're diversifying into areas that very unexpected. But I think if COVID has taught us anything, it's that how adaptable we can really be. And so I think that for the right deal, if it provides insulation from risk that they're now currently highly concerned about, then those deals are getting attention. So that's a current trend that we're seeing right now that we're monitoring closely. And from an advisory standpoint, it's really expanded the way that we are trying to help people piece puzzles together about what deals make sense, how they can create value, how they can solve problems. And then for some folks, they're like, hey, we would have never taken this to you 18 months ago, but because other folks are considering this, we thought you might want to consider something similar. And that's happening.
Interesting. So along those lines, what are some of the things that, as far as like, value adds that are making these companies attractive to other companies wanting to acquire them? Is it, access to a driver pool, and by acquiring this company, they're going to acquire X amount of drivers. Is it some other secret sauce that no one's really talking about? Because what I hear day in, day out is I need drivers. So that's what's first and foremost on my mind.
Well, I think that's what the deal is, as far as like going back to like provide a little bit of color. Why would they consider going and diversifying into something that they don't yet understand? It's the drivers. It's the drivers, because it doesn't matter how clearly and how special and how clearly I understand something, how specialized I am. If I can't go execute, it doesn't really matter. So the question is, where are the drivers? Can I acquire the drivers plus trucks plus revenue all in the same swoop? Insulate risk, give me some protection from the downside, but also continue to grow. Then that it's a significant value driver right now. Another trend is that we're seeing is that with so much disruption in the supply chain, we're seeing people that, hey, historically we've tried to tuck in and kind of have smaller deals, but the reality is now, like, that we need, in order to win the future, we need to be serious about acquiring the right talent that's going to get us there. And so some of the trends are large, sophisticated organizations understanding where their weaknesses are and understanding their own limitations to home grow that talent, and just saying it's more cost effective just to go buy it. So from leadership, from talent, from everything else, we're seeing the expansion of these profiles being much more thoughtful and strategic. Because I mean, think about like logistics, supply chain. Nothing there's never been a time in my lifetime where it's been more front and center. I mean, this is where there's the greatest problems. It affects every industry. It's crazy. And so, like, for that reason, it's exciting because it has the ability to now attract some of the most amazing talent, brightest minds, critical thought leaders that we've ever had to bring into this industry. So I think it's a really exciting time.
Of acquisitions, how are things different between, a culture that uses predominantly a W-2 employee-based model as opposed to a 1099 independent contracting model?
Well, number one, that either one can be and has been successful. I think it's more about preference, or historically has been about preference, just the way that people want to do business. People that are generally an independent contractor, they see themselves as an entrepreneur. They want to work for themselves. They see more potential upside. Maybe the potential has some multiple revenue streams as part of that. And whereas an employee, they want to turn the clock off when they're done. They want to move on and move forward. And so, there's pros and cons with each model. I don't think there's anything bad. You just have to understand who you're dealing with and how they want to do business. And I think up until probably 18, 24 months ago, part of having a vibrant culture was kind of understanding like where's their continuity, and usually it was more common to have like either all of one or all of the other, or some partial blend, but certainly some strong commitments about how they interact with one another. I think what's changing in the market now is because the driver shortage is becoming more and more pronounced by the disruption within the supply chains, and quite frankly, it's just it's probably a good thing because it's forcing folks to come in and understand how to coexist, how to run these types of business models and parallel, make them complementary to one another. And I think what we're discovering is that you can have a culture where both these things exist. It's just a matter of kind of threading that needle and making sure that the values are there, making sure that there's continuity on basic compensation, so that the incentives don't go the wrong way for the folks involved. But really, I think that that's what we're seeing on the acquisition profile standpoint, is where we used to have these super hard positions. It's only employee models, it's only IC models. And now it's like, hey, we've got to mature. I mean, we've got to mature with the developments in the marketplace and figure out how to make this work. Because if we don't figure out how to make these things coexist, then we're going to really stagnate, and we're going to lose people. We're not going to grow, and we're going to lose business value. So I think that's the tension in the marketplace.
Okay. So then for a company that's looking to be acquired that uses an independent contracting workforce, what are some things that they should do to attract a buyer? And what sort of things do they need to do then to get their house in order?
Well, I think there's a couple of things. I don't think they have to try real hard to get the interest of a buyer. I mean, if they've got a certain amount of volume in sales and they have the drivers, whether they're employer, independent contractor or not, they're going to get interest. I think the question is, what are you going to actually do to get paid or actually complete a transaction? I think that's where we see folks not maybe being forward thinking enough, because the reality is there are, based on the legal environment around us, that there's certainly a cost, and there's certainly a tremendous amount of exposure for not dotting your I's, crossing your T's when it comes to have a legitimate difference between an independent contractor and an actual employee. So I think a couple of things that we recommend: just make sure you get the right counsel. You need to be talking to your insurance solution provider. Good friends with folks over at Scopolitas and Greg Fury over there. They do phenomenal work in terms of misclassification. I think Heidi, again, several different attorneys across the country are great. But and another point, just in terms of just some dry runs as far as reviewing your agreements. Are they satisfactory? Can they withstand the scrutiny of a due diligence process? Because I think that's ultimately what you're doing, is you're transferring risk. Right. So what we're trying to make sure is, can your business withstand the scrutiny of getting through due diligence process? And so we're talking about what, you have to go through those documents and get them reviewed and make sure that they're going to be able to withstand the scrutiny of a buyer and that buyer's attorney. Because if not, if there is the potential, and that's all it is, it's the potential to create some type of legal expense, exposure, lawsuit, post-transaction, then it's probably going to be looked at. It's too risky to be worth it to go through with the deal. Right. So those are things that companies can easily do preemptively. Like I said, by getting with your attorney, get the insurance solution provider, and then, obviously with a group like Open Force, to making sure that they have things teed up. Because what ends up happening is, if they're not ready, they end up doing this scrambling thing in the middle of due diligence, and it's disjointed, and it doesn't play well for the buyer. It looks like you're disorganized. So like if you're working with those contacts and you're scheduling kind of regular fire drills that you can, you're understanding what a buyer's going to be looking at and you're ready for it, then that due diligence is going to be pretty seamless.
Got it. That makes sense. So then too, what are some of the people that are making the acquisitions right now? What are they doing really well at that is helping these, them acquire more businesses, and kind of doing what you just described, but on the acquisition side of things to make things go smooth?
I think part of the deal is a few things. Number one, they take their whatever their potential acquisition profile or target profile description is, and they cut it by about 75%.
Okay.
And I think, and the reason why I would say that is because when people are too broad and what their profile could be, they don't really get deals done. They look at a lot of deals, but there's too much to look at. They end up not doing anything.
So by acquisition profile, do you mean like as in terms of like market verticals, or what does that mean?
Yeah, I would say verticals. I would think, regions, size.
Okay.
The people that say like, hey, they understand, they look within, where are we most vulnerable? Where is the best chance for us to grow? And then if we had to dial in exactly what's the profile for that company to do that, they thoughtfully consider that. And so when that happens, not to say that they wouldn't do other deals or whatever, that other deals can't be good, but just the discipline itself requires people to get a little bit more serious about what do we expect this acquisition to do for us outside of just adding drivers. And when they do that, it often streamlines a lot of time that goes towards evaluating deals that can't match what that profile can do for them. So what it's doing is, in this industry with so much disruption, you don't have any bandwidth to spend a lot of time evaluating deals that you're not going to close. So we're trying to shrink that workflow, evaluate the deals that have a high probability of closing. That's it. So, and that have a high probability of maximum impact. So that would be step one. Number two is that people that are highly effective in getting deals, they start with the assumption that they're going to be satisfied with the majority due diligence and make sure that they're going to be in alignment on the money. Once they do that, and I mean that from like a non-binding range of offers, pre-due diligence, because there's a tendency for buyers to, especially inexperienced buyers, to do heavy due diligence on things that are not material, especially if you don't even know if you're in alignment on the money. So when you go in the sequence of, hey, let's find out, like, hey, we understand the business, like we're not new to trucking, logistics, and transportation. So assuming that everything that we're going to find out, we're going to be satisfied, where are we going to be on the money? The best buyers do that first. Then, if necessary, they do the due diligence, and that saves a tremendous amount of time. The other part of it is it's extremely courteous to the seller involved. Why? Do all these things that make them feel vulnerable and compromised if you don't have to. Because what ends up happening, if you say we're not aligning the money, maybe 6 months later, something changes. They like the way that you did business and they say, hey, things have changed. I'm ready to evolve on my value expectations. Let's come back and let's do a deal. That's what happens. So I think like working within that sequence is key. And the other side, I think, is just the people that are acquiring, that are doing the best work right now, are very open-minded when it comes to structure. I mean, when it comes to like, if you get really dug in on what you've heard businesses are worth or what they're valued, you're going to have a very short runway. So there's a lot of ways to structure deals, irrespective of what value we place on them. It doesn't really matter. Ultimately, what we're trying to do is to get a deal done that accomplishes both parties' goals, where there are also some combined shared risk. Because if we're not addressing both parties' goals, or if only one party is having the risk post-transaction, it's very low probability that we're gonna get anything done. So what I hear people doing a lot of deals is to say, hey, Spencer or Tenney Group or whoever, this is how I've done things typically. If you could show me a better way, or an alternative that can still allow me to get my goals addressed, and still provide me this required return on investment, then I'm open. I think so. Like that attitude is what and I'm not saying just with Tenney Group, I'm saying in period, a little humility is often the difference maker when someone's going to like, are we going to get the deal or is this guy going to get the deal? Because if there's a creative solution that I don't yet know about that can help us all win, let's hear it. So I think that's especially in this environment where it's, kind of like the wild, wild west out there. It doesn't always make sense to throw more money in the pot. The answer might just being a little bit more creative on how to address each party's respective goals.
Got it. And this, as you're speaking, because that all makes sense. I'm kind of almost wondering with in respect to just outside factors that might be threatening a merger and acquisition. what do you think in the current climate with everything going on in these industries would be a barrier to getting the deal done outside of either party's control as of 2021, if there is anything?
I mean, there's 1,000 things. I mean, so, I mean, seriously, I mean, we've seen everything from, you know, we had a client that had a deal and we were under contract, and then they got notice that they were losing their, you know, their number one customer that is 80% of their revenue while we were under contract. So those types of things. And it was just, I mean, part of it was performance, but part of it was just because of their specific issues. They had different needs from a capacity standpoint, and they had to go change providers. And so like, we can't really control that. I mean, like I said, partly performance, but a lot of it just had to do in response with what everyone's experiencing right now in this environment. So I think, you know, that's one thing. You know, there's all kinds of things in terms of regulatory things. There's, you know, tax environment. There's certain things that can happen that take the financial justification for doing a deal off the table. Those are, I mean, every deal has a certain amount of things that we just can't control. So I think part of the deal is, of getting deals done, is to try to expedite when a buyer and seller have committed that they want to do a deal together. Part of getting it done is getting all the things satisfied. It doesn't mean don't do due diligence. It means efficiently get through everything as quickly as possible, so that something that neither party can control can disrupt what would otherwise be, you know, highly beneficial for everyone post-transaction.
Makes sense. And I just asked because, as we were talking about earlier, you know, it just seems like there's so much volatility in the market right now, but it's good to hear that people are still, you know, making mergers and acquisitions, and we're still talking along. And like you said earlier, there's more light being shown on the logistics industries, and hopefully it attracts more people to that line of work now that, you know, like, you know, the government's unemployment benefits are all, you know, have come up, and people need to get back to work, and we need to get things delivered. Everything backed up in the ports. I mean, if anyone's watching the news and seeing what's going on the East Coast, West Coast, Mississippi, you know, stuff needs to get to stores so we can all get on with our lives and get rolling.
Well, yeah, I mean, you know, like even these things that we've talking about offline, you have these world events as far as, you know, China and Taiwan, and it takes a couple of yo-yos across the ocean to literally cause a major problem that, you know, not only can ruin an acquisition, but fundamentally affect our whole lives of how we do life. So I think that's the reality around what we do. And then you add to that, just as far as, you know, trying to track things in terms of debt ceilings and things like that. What does that mean from potential recessions associated with that? And I don't think that's going to happen, but yeah, if that does, if it affects the capital markets, then yes, it's going to affect the way that people view value.
That's something I think about quite a bit as well. But it seems like right now, with especially the way people's behavior and buying habits have changed over the last year and a half, it seems like the logistics industry is not going to go out of, you know, already, you know, we depend on it so much, but even just because of how much we've changed as a people, is going to be, you know, kind of, I would argue to say, and knocking on wood, you know, maybe recession proof. Am I wrong in that, you know, assumption or that thought?
No, I definitely don't think it's recession proof. I do think that there's I'm just, I've seen too much in the last 48 years that we've been doing this. It's certainly not recession proof. So, but I agree with you in the sense that it appears that at least for the next 3 to 4 years, like it's hard to see a scenario in which there's not incredible demand for what this industry offers. And so for that, I think there is some significant insulation. I think that where there's potential disruption, like where you see asset light companies on 3PL, we've seen you know, steady valuation increases over the last 7 years. And so it's like, how sustainable is this? Probably not much. I mean, if you know, when you haven't had a significant interest rate increase in over a decade, so like it's hard to see that at some point that would normalize. But barring, like you said, barring a recession, it's hard to see anything that could affect, at least on the asset light side, those valuations, because the reasons why those valuations are so high, in my opinion, is because unlike on the asset heavy side, where you have to have ongoing capital expenditures and it's going to dilute the overall investment over time. The asset light, you can scale so fast with very limited capital expenditure. And I think that's why these valuations are in some ways at first glance kind of insane, but you can understand if you can grow 50% year over year, then you can get there as far as what people are paying. And it makes sense. I think that you see less swings either on the recession side and on, in the best of times we're at right now on the truckload, because you're still dealing with assets. And one of my concerns is dealing on the asset side is that here we are with all this increase in both new and used. You can't get the new equipment, and the used equipment's getting more expensive, which from a balance sheet is not very helpful, because we're still going to have maintenance on these issues. It's not really going to help that from driving earnings. And then we're still going to have higher amount of debt on equipment that's not worth as much,
right,
in a different environment. So I think that's a concern of mine as far as can these moving forward, if we don't kind of get out of this situation on the truckload side, can we hold values? Where on the asset light side, I think that we can. It's less clear on the truckload.
Got it. Okay. Yeah, that's something I've been hearing a lot too when I'm reading and listening to other industry experts as well. It sounds like we're kind of going to be in this kind of climate and environment. I hear two conservative estimates, one 2023 and another being 2025, as far as supply chain issues. So I guess kind of what's your take on that? Because then it sounds like too that kind of will help people understand like what kind of environment to expect in terms of, if they're looking to, merge or acquire in 2021 and beyond, what they can maybe expect. And do you think it'll be a conducive environment to continue to acquire, other companies?
I think to the degree that debt remains as cheap as it is right now, it's going to continue to be not just a great environment. It's just like it goes back to, like, I'm not trying to sell the concept of acquisitions. The realities are, if you don't have trucks, you don't have drivers.
Right.
It's essential if you're serious about protecting what you've got, because all the other expenses are rising. Even if the pricing is going up, the other expenses, insurance, driver pay, they're all going up. So you have to have something to offset that. And so when you're in a low margin industry, you need that scale and volume to start capitalizing on all of the innovations and the technology that the trucking and logistics industry has produced in the last 5 to 7 years, which are phenomenal. It's just like, but you can't fully capitalize on that without scale.
Absolutely. So what I'm hearing, and I'm a bit of a simpleton and a newbie to all this stuff, but now's a good time, and it looks like kind of the next few years are going to continue to be good times. What are some things that I guess would kind of keep you up at night right now, or would make you tell someone to kind of pump the brakes in terms of just industry and overall, national and global setting, I guess?
Well, I mean, I'll tell you right now, I had a person literally today, has nothing to do with this conversation whatsoever.
Okay.
About an $80 million carrier, independent contractors, major misclassification issue. And he's asking me straight up, I'm done. Can I go sell? And I'm saying, honestly, I don't think that's a good use of time. I think that you need to figure this out. You need to get this thing handled. There's some other disruptions that are going on right now, but we've done deals that have had, major lawsuits in motion at the time of closing. They can get done, but this is there's just too many other options. Like you can go get done what you need to get done with someone who doesn't have that. And so I'm literally telling him, I think that you need to hold off. I know you're frustrated. I think that you're going to make a lot of concessions that 2 years from now you won't make, and you won't have to make. So in that situation, I'm saying, I think you need to pump the brakes and tough it out, because otherwise it's going to be too punitive in a transaction environment. You're going to regret it.
Absolutely. Well, Spencer, I've really enjoyed our conversation. And as I understand it, you also have a podcast. So if someone wants to hear more from you and get some expertise that you're dropping, where would they go, and what's the podcast name?
Well, pretty much we just distribute it through YouTube. That's pretty much where we work on, and we call it In the Hot Seat with the Tenney Group. And what we try to do is just to bring thought leaders from all over the transportation industry spectrum and hear from them. I mean, we're doing stuff in M&A, but there are so many important issues that we really need the experts all at the table to really get the best information, and that's what we try to do through that program.
Excellent. Excellent. That's great. And be sure to check them out. Spencer, it's been a great time talking with you. Any closing thoughts for our audience?
Well, I just think that you know, whatever you're doing, if you're an employee model, if you're an independent contractor model, you need to understand the role that that's going to play in terms of if you have any interest in doing a deal in the next year to 3 years, just start doing your homework and start preparing. And I think what that's going to do, it's just going to create options, and it's going to make you have a much more seamless experience. And you're going to be able to attract more value because you're going to project less risk to a potential buyer. And you'll just present better. So I would just say, do your homework, surround yourself with the right people. And whenever you do decide to find out what's available to you in the market from a sales side standpoint, you'll have a much better experience.
Excellent. Thank you again, Spencer. We really appreciate you joining us and being an expert on our podcast here.
Thank you, Nick. Enjoyed it.
Thank you. And for those listening, be sure to check out the show notes for Spencer's podcast that you can check out on YouTube. We'll have the link there for you. And Open Forces, as always, it's been a pleasure having you with us. And stay tuned for the next episode of the Gig Academy. Thanks, and have a great day.